Is HDFC AMC a compounding machine or an expensive illusion? With zero debt, 32.9% ROE, and unstoppable cash flows, the real question is, does the valuation still make sense? To get the full picture, we're breaking this analysis down into 4 critical phases. First, we'll look at top-line growth and profitability. Second, we'll examine their market dominance in AUM. Third, we'll stress test the balance sheet and cash quality. And finally, we'll wrap up with a valuation and risk assessment. The high-level numbers for FY26 are nothing short of stunning. Total revenue surged 18% year-on-year to over 4,118 crore rupees, driven by a 20% jump in total assets under management, which now stands at a staggering 9,275 billion yuan. Efficiency is the name of the game here, with 97% of transactions being executed digitally, leading the board to recommend a final dividend of 54 rupees per share. Looking at the core income engine, Q4 revenue hit 1,050 crore, a 17% increase that tracks directly with AUM growth. Despite rising employee costs, the company achieved strong operating leverage, with core operating profit up 16% to 822 crore. Most importantly, operating margins have held perfectly stable at 35 basis points. Now, let's address the elephant in the room. Why did Q4 profit after tax drop 2%? It wasn't the core business. The drag came from a 93% reduction in volatile other income and treasury gains, which fell from 124 crore last year to just 11 crore this quarter. The core fee-based business is actually booming. The drop was just a fluctuation in paper gains. HDFC AMC is an equity powerhouse. Out of their $9,275 billion total AUM, a massive 65%, or $6,050 billion, is in actively managed equity-oriented funds. This is a huge competitive advantage because actively managed equity carries much higher margins, serving as the primary fuel for the company's high profitability. Their dominance is reflected in their 13% market share in active equity. What makes this capital sticky is the retail focus. 68% of their investors are individuals, compared to an industry average of 60%. They've also mastered geographic reach, with nearly 20% of their AUM originating from B30 cities, supported by a physical network of 280 offices. They are essentially a systematic investment machine. In March 2026 alone, SIP flows reached 48.8 billion rupees across 16.5 million transactions. With 97% of this volume executed digitally, this unprecedented retail momentum creates a massive, predictable baseline for future AUM growth. Turning to Phase 3, the capital structure is a fortress with exactly zero total debt. Net worth has surged to over 9,231 crore, fueled by strong retained earnings. Liquidity is also exceptional, with 91.3% of their 9,396 crore in total investments parked in highly liquid mutual funds, making them virtually immune to credit shocks. In the world of finance, cash is king, and HDFC AMC's earnings quality is elite. Out of the 2,859 crore in FY26 PAT, they converted 2,530 crore into hard operating cash flow. That is an 88% cash conversion ratio, meaning these profits aren't just accounting entries, they are rapidly turning into deployable cash.
This is a highly efficient machine, with return on equity expanding to 32.9% this year. Because it's an asset-light model requiring only 22.6 crore in annual capex, they can afford to be generous. They maintained a 78% dividend payout ratio, returning 1,925 crore to shareholders through interim dividends alone. When we run our diagnostic red flag checklist, the company passes with flying colors. Is there a gap between profit and cash flow? No. Is there margin deterioration? No. Margins are rock solid. Is there dangerous debt or a capex drain? Absolutely not. It's an elite, asset-light financial profile across the board. Of course, quality comes at a price. HDFC AMC trades at a premium multiple because of its high ROE and brand moat. The bull case is built on record-breaking SIP flows and retail dominance. However, the bear case reminds us of regulatory sensitivity to SEBI expense ratios and the fact that revenue is directly tied to market volatility. So, what are the 3 key takeaways? 1. Core growth is exceptionally strong, with operating profit up 16%. 2. Earnings quality is top tier, supported by an 88% cash conversion rate and a zero debt balance sheet. 3. It is a compounding machine, intrinsically tied to the structural growth of Indian equities. Does HDFC AMC deserve its premium valuation, or are the regulatory risks too high? Drop your bull or bear case in the comments below. If you found this HDFC AMC earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.